Hi everyone, Greg Towner here with Parallel Portfolios, ready to talk about the markets in our five charts in 5 minutes for January. So let's get right into it. Well, we of course like to start off usually with a chart of the S&P 500 over the last 3 years. This blue line is the S&P, the orange line is the 200-day moving average. You can see here recently, late last year, early this year, the market had a bit of a correction. But as I speak here now, Wednesday morning, just a little bit after the latest inflation data came out, market is trying nicely to rally from an oversold level. We'll see if this holds, but it kind of developed a little bit of an area where maybe it made sense for the market to start to try to move higher again. As we talked about, sentiment got a little bit too stretched late last year. Everybody was getting just a little too excited. Every once in a while, the market needs to, really remind people that it doesn't only go up. So at the moment, we're just picturing this as a modest correction and perhaps putting in a low point here on the back of the inflation data. We'll see as the time goes on. But what's probably most important right now are interest rates. So this is the 10-year yield over the last couple of years. You can see here the last 6 months, interest rates have really rallied sharply for a variety of reasons. But now on the back of this more modest inflation data point, rates are coming off nicely. This is hugely important because this will help drive certain areas of the stock market that had been negatively impacted, whether it's dividend payers or some of those that pay high interest rates on their bonds. This will really help the market as a whole. And if they were to come down further, it could help the economy in terms of making mortgages more affordable and all of that. So we'll be watching this closely. There's a lot of things that go into interest rates. A lot of people have been wondering what is driving them higher. It could be risk of inflation, it could be better growth, it could be concerns about upcoming policy changes, probably all the above. But for the moment, at least, rates are coming down a little bit, and that's a good relief to see. So that's where we're positioned right now in the market. But I think let's just take one more look back at 2024 to see how we got to this point. So all these lines on here are what individual asset classes did in calendar year 2024. So this brown here at the top, huge return, incredible return for the broad growth index we can see. Purple return was the S&P 500. So a couple of fabulous, fabulous returns, a couple of years in a row, frankly, for those now. But as we go down the measures here, we can see that different asset classes, still stocks, but just different areas, didn't perform anywhere near as well. This kind of orangish color here is the Dow Jones Industrial Average, 15%. Great year by any measures, but nowhere near these other two. The dark green was the Value Index, 14%. Great year, but not compared to, say, growth. This kind of medium green here, this is very interesting. This is the S&P 500, but equal weighted. So each of the 500 stocks, the same weight, as opposed to the purple, more than twice the return, that gave heavy weighting to the larger companies. And then so on. The blue is the small cap index, the pink is international. So huge disparity in returns depending on certain asset classes of the equity side last year. Well, let's drill down into that just a little bit more here. You've probably heard the term Magnificent Seven over the last few years. This chart looks at going back to 2021. This row here in gray is the S&P 500 return for each year. But the blue is the S&P 500 if you excluded just those seven stocks, which are primarily the mega cap tech related type names. You can see that the return without those seven stocks is going to be significantly different than the S&P 500. Only in this one year was it a better return. It was a negative year for the market, so it was better without those stocks. But the other years, much, much worse return for the market, excluding those seven. We can see their share of returns were, roughly half or more in most of those years. So clearly, while there are a number of stocks out there that have done well, the huge returns for the market indices have been driven by these mega cap technology names. How long that will last is hard to say. We compared it to some times historically that look at the difference between great companies and great stocks. We think these companies are going to remain leadership in their roles as companies, and we own many of them and really like them. But at any given time, there could be a difference between how a company is doing and how a stock is doing. So we think there's a chance for rotation to finally occur into some of the other areas of the market that have been somewhat left behind for the last, several years now, frankly. Well, our last chart of the day is frankly one of my favorite I've seen in a while. It's very simple. It goes back over the last 40 calendar years and looks at the S&P 500 returns in each of those calendar years. If it's colored in green, the market was positive that year. If it was colored in red, the market was negative for that year. And you can just see so easily, so visually here, that how much more frequently markets are up. And even in the handful of years when markets are down, we can see that, a few of them were just in the single digits. Yes, a couple of bad years, no question. But so much more frequently are markets up in any given calendar year. And I like the titling of this chart. Investing definitely has risks, no question. But sometimes if you have a longer term time frame, not investing can be even riskier because you're missing out on these potential returns, subjecting your other investments to the impacts of inflation and so on. So keep this chart in mind when you're wondering about should I mess around with my money in the short term and behave emotionally? I think you know our answer to that at this point. So in some, stocks appear to be trying to rally from an oversold level here based on the back of more modest inflation numbers. So hopefully this holds and we can rally throughout the rest of January. The direction of yields, probably the most important thing happening right now. If we can continue to get some relief to the downside in yields, that's going to be a real positive both for the stock market and potentially even for the economy as well. As we showed, 2024 returns really driven by a certain area of the market. That's probably not sustainable, but we'll see. It could go on further than people expect. And remember, not investing can sometimes be just as risky as being in the market. So if you have any questions, please feel free to reach out and we're happy to help. Take care.